When addressing what ownership or investment structure we need to place our investments in, we have the following structures available: self-ownership, joint, either tenants in common or joint ownership, company, trust, self-managed super fund. It is very important that we structure our investments correctly from the start. Getting it wrong will mean additional taxes and stamp duty if we decide to change or transfer our investments to someone else. Own or self-ownership is very simple. The investment will be held in our own names and all income and expenses and any tax benefit will flow to ourselves. The same will apply to joint ownership. However, costs and benefits are based on a percentage of ownership. Under a self or joint ownership, each owner is entitled to a 50% capital gains tax reduction provided they've kept the investment for greater than 12 months. However, any income, including capital gains, is taxed at the marginal tax rates up to 46.5%, and there is absolutely no asset protection. Under a company structure, all income is taxed at a flat rate of 30%. However, a company is not entitled to the 50% capital gains tax reduction on investments held for greater than 12 months. Losses caused by negative gearing are trapped in the company, and taking any money out of a company can cause other tax issues. In a discretionary trust structure, the net income of the trust can be distributed in any proportion to any of the beneficiaries by the trustee, and is essentially taxed at the individual's marginal tax rates, which can expose the income to a tax at 46.5%. One of the major drawbacks of trusts are it can't distribute any losses caused by negative gearing to its beneficiaries. The loss is quarantined in the trust until such time as it makes a profit. If an investment is purchased via a self-managed super fund, there are significant tax savings. A super fund is taxed at a flat rate of 15%, and if an investment is held greater than 12 months, the capital gains tax payable is effectively 10%. The hidden benefit in a super fund will become apparent when the members are in pension phase. The earnings and the capital gains of the fund are taxed at 0%, and any pension the member receives for the rest of his life will be taxed at 0%. Before making an investment, you should seek expert advice on the correct structure for your circumstances. By not getting it right from the start could mean potential stamp duty and capital gains to pay, which may be very significant. Whenever considering an investment, the initial choice in structure requires professional input. There are more than yearly tax savings to consider, like capital gains tax, transfer investment to someone else without any capital gains tax, bankruptcy, business failure, divorce, death, succession planning, and incapacity to work. If you're at the point of considering purchase and investment, contact BCG to get the right advice the first time.